Hi, this is Todd with Integrity Investment Advisors. Here's a great new video update for given where markets are at. We're right before the election. Markets are very close to all-time highs. And we want everybody to be thinking, how much risk do you need to take to hit your goals and your lifestyle in retirement? And this is very important to be asking now, just we've had a great run over the years, which I'm going to walk through in this video. The answer to this is financial planning. So we have great software that can help you do this and right size your risk, how much risk you need to take, and make sure you're on track for your financial plan given the market's strong performance over the last several years. So on the agenda for this blog, you can pause any of these slides if you want to look at more details. But we're going to cover the upcoming election, which is tomorrow. We're going to cover U.S. stocks. They've been up about 35% in the last 12 months. U.S. bonds are up 11% in the last 12 months. And really the lesson learned over the last 4 or 5 years is inflation is the enemy. So if you need help, we can help. And if you're a current client, schedule a call and we can review and update your financial plan from here. So presidential cycles are normally positive. I know there's a lot at stake here for this next election. It's going to be very close. There may be some recounts. There may be some volatility. But at the end of the day, we're going to figure out who the winners are. We're going to have a transition, and the companies in the markets and us as individuals will adapt to whatever the new regime is. And eventually down the road, we are going to have to deal with the deficit, which is one of my major concerns, and get spending a little bit more under control. But in general, over the 4-year cycle, stocks usually go up over that period. They normally go up a little bit more in the second 2 years of an election term. And we've had a very good run to date. So stay tuned on this. Hopefully we'll get through this and know a winner in a short amount of time. So we just started cutting rates, and here are some data. We're very data-driven as a firm. If we get the first Fed rate cuts in no recession in the next 12 months, stocks normally do well. We're sort of in this mode today. We don't think we're going to have a recession in the next 12 months. And stocks and bonds normally do okay. If we do have a recession in the next 12 months, obviously stocks go down on average in recessions, and bonds will do okay. So I think having bonds in the portfolio is a good diversifier, especially where we are at today. And here's another sample of that. If we have a recession in those scenarios, stocks, again, go down over the 3 to 12 month period. We think we're more in this camp today where they're cutting and there's not going to be a recession. And generally, stocks are up after the election and over the next 6 or 12 months. So we'll see where this goes. Again, I said the enemy is inflation. If you go back a long period of time, this is since 2000, you can see healthcare and tuition and healthcare services have gone up quite a bit. TVs and electronics have gone down. Cars are up over the period. So we really want a real return over time. And I think even if we just shorten this to 2019 or 2020, the beginning of 2020, you'll see inflation was a real big problem, and stocks did quite well. So we do want to own stocks for the long term, and that will help us. So sitting in cash over the last couple of years, we've had a lot of clients. We have a great Flourish account, which I'll show you here in a sec. But sitting in cash is less than optimal over long periods of time. So you might need to right size your cash account. We do have a lot of clients that have been carrying a lot of cash, and I'm going to encourage you to move that to something more productive. But you can see over the last couple of years, stocks have been up a lot, although the return on cash has been okay, 4 or 5%, about half of that year to date. But when you compare it to a 60-40, obviously a 60-40 has done quite a bit better. So having too much in cash can hurt you, and if you have a lot of cash, we normally say money you need for taxes, money for any vacations, and then maybe a small emergency fund from that standpoint. Anything above that, I think you want to invest in your Schwab accounts and longer term. And then cumulatively here over the 2 years, stocks are up about 50%, 60-40 is up about 33%, bonds are up almost 9%, money market's up almost 8%, but keep in mind inflation was probably around 6%. So we want real returns ahead of inflation. All right, yields on cash accounts are coming to an end because they are cutting rates, and we want to focus on what you keep after taxes. So taxable accounts at Flourish, I think we need to move out of some of those. It's okay, again, to keep a small amount over there, but if you're in the 24 or 32% bracket, any of these, your after-tax return is around 3%, maybe a little bit over, and we think inflation is around 3.1%. So your real return is very small or negative. So don't keep too much money in cash. Let's get this invested. And the other thing is this 4.5% is probably going down, which I'll show you in a slide later on. This will probably be 3.5% in the next year. Okay? 2024 and 2025 might be great years for Roth conversions. This should be on everybody's radar. We are talking to clients about it, and we want to make sure you know potentially taxes are going up in 2026. So 2024 and 2025, we believe, are great years for Roth conversions and filling up your buckets. In fact, if you're in the 24% tax bracket, which married filing jointly is about $383,000, we feel like you should be filling this up with Roth conversions, even if you're not retired. Okay? So be looking at this, and Roth conversions are great during low income years if you're changing jobs, if you're in lower tax brackets, if you believe your tax bracket is going to be higher in retirement. We do it a lot of times once you retire, which I'll show you on the next slide. If we have a market recession or downturn, we will look at doing Roth conversions. And it really helps for surviving spouses and for your kids and estate taxes if you do more Roth conversions. So we are reaching out to clients. If you're not a client, we can look at this for you. This is a big deal. So we want to make sure we focus on this. And Roth conversions, once you do retire, so if you're a high earner and you're not able to do Roth conversions while you're still working, typically if you retire at say 65 or so, we have 5 to 7 or 8 years where we can do some Roth conversions at lower rates, and this will really help you in retirement. So be thinking about that. We want to be proactive. We work with this. We do this for all clients. We take a look at this, and we'll give you feedback. So if you don't have that, or if you have questions about it and you're a client, let us know, and we'll set up a meeting. And if you're not a client, we have a second opinion, which you may want to get some ideas on this strategy. So if you're going to do Roth conversions, it's important that you have taxable assets to help pay for that. So if you're a high earner, we want to build up some taxable assets. So in general, if you have deferred accounts, 401ks, 403bs, IRAs that are tax deferred, this could be a ticking time bomb for you. It'll cause surcharges, higher RMDs, a widower's tax, and phantom taxes along the way. So we want to see some tax diversification. And in general, once you retire and you go through some Roth conversions, we typically like a third as far as asset levels. While you're still working, if you're a high earner, it might have to be more focused on these two areas, your taxable account to pay for Roth conversions, and then doing Roth conversions after you retire. So if you have a very high IRA or 401k or 403b account, we really want to focus on maybe investing less, maybe splitting it between a Roth, maybe doing some Roth conversions, or certainly building some taxable assets. And again, we convert these to a Roth sometimes when you're working and sometimes after you've retired. And I think if you're in the 24% tax bracket, maybe up to 32, we should really be looking at this. And again, we've had above average returns the last couple years in the top percentiles, 92 percentile, 83, 71. When you look at it, and with clients, we actually think about how do you own your portfolio, sort of these 0 to 4 year buckets, 4 to 7, and then 7+ years is long-term investing in equities. So we've had very good returns. It's a great time, again, to update your financial plan with us and make sure we're taking the appropriate level of risk. So if you're a client or want to be a client, this is sort of how we think of our framework. Is if you're close to retirement or in retirement, we typically like sort of 4 to 7 years worth of cash flow and safer investments in bonds. We use this for liability matching your cash flow. And then we have a middle bucket that has some hedging opportunities. This is with AQR and JP Morgan and some other strategies we use in this. Provide good returns, better diversification, and some volatility reducers. And then in the 7-year bucket, we have really long only equities with S&P 500, Avantis, dimensional funds, long-term investments. So these can be quite volatile, and we believe owning bonds and owning this middle bucket can help with diversification here over time. And again, we really think of an investing framework built off of this. We start with beta, which is indexing and market cap investing. We add factors on top of this like high profit and quality and momentum and smaller companies and dividends. We have some macro bets with AI and technology. And then at the very top, we have some diversifiers that can be long and short with AQR, some puts and calls, and some hedging, from that standpoint. So this can be a little bit more expensive. That's why we don't do a lot of it. But this is how we build very economic, cost-effective portfolios. And then we scale this to how much equity risk do you need to take in your portfolio. So we believe this is the best way to build portfolios. And if you want to have a call about your personal portfolio, please set up a time and we will discuss that. So if you have questions, please book a meeting. We have great software and tools to help you. The markets have been very good, and it's a great time to update your financial plan and your spending and retirement. Talk about Roth conversion strategies. Talk about anything else on this list, AI or crypto or blockchain. We'll know about the election here very soon. So if you have questions and you're a client, please book a meeting. If you have questions and want a second opinion, if you're not a client, please book that. We have a great strategy, which I'll show you in a sec. Our software is designed to give you more confidence about your retirement path, help you get from where you are today to where you want to be, and we give you confidence to do that. And we also help you to live your best life possible. So we take that very seriously with your goals and to align your money with your goals. So give us a call and set up a meeting. We can help. Here's our second opinion process. It starts with a discovery meeting. Many of our clients say they wish they would have known this 10 plus years ago, but here's a discovery meeting. We set up a phone call. You can book it on my calendar. We gather your data and you upload critical information to us securely. We will analyze it for free and book another meeting with you. We'll identify the red flags. Then we have the other meeting. We'll give you the report. You can then sleep on it and decide if you want to become a client. That's great. And if not, at least you know great information about where the red flags are, what your fees are, if you're on track, and what you can do to improve it. So if you become a client, we will help you with onboarding. We custody at Schwab. We have a great process to really help clients. So book your meeting below. And if you like this video and think it's useful, please share it and like it on YouTube. Thank you so much. Appreciate your time, and best of luck to everybody.